Hello. This video is focused on looking at how financial planning software and financial planning can help business owners explore their exit opportunities and how that will affect their financial position in the future with and without business sales. This is some kind clients of Beckett's who have been exploring some opportunities and have allowed us to anonymize their data and use this as an example for other business owners. As ever, we run through the circumstances here. It's a really interesting family, relatively young with regards to a business exit. Mrs. is 37, Mr. is 39. They actually have twins aged 7. Mrs. runs a really successful beauty business with a partner of hers, a business partner. She owns 50% of it outright and they've built it from scratch. It's done incredibly well and they are now exploring the opportunity of selling the business. Mr. runs a construction business himself, however he doesn't envisage a significant exit, but it does generate a really solid income for him. As a family, they do like to spend. They have general living costs of around about £10,000 per month, but they have around £10,000 a month, yes, £70,000 a year of holiday spends that, due to the nature of Mrs.'s beauty business, most of this is paid for by the company. And so when they retire, this is something that they want to continue and fund well into retirement. So this is a real consideration of theirs, as they don't know how they can afford to do this. Because they've been building up their businesses, they've generally been spending the money that comes in, and their focus is that they will sell their business, and that is what will provide their future security. With that in mind, and for their income and ages, they have relatively small savings. They've done some historic ISA savings at a very small level. They've got £85,000 that they hold in cash. They did create what's known as a family investment company, and this is a company that holds a property that they rent, a commercial unit, that provides £12,500 worth of income to them each year. And this is a vehicle that we can use if they were to sell the business. The trading beauty business has a significant value. They valued this at 20 million in this instance. However, they are hoping to achieve 50 million exit valuation within the next 3 years. And this is relatively well supported by their accountants. The main residence is the other main asset that they hold. They've been investing into this significantly, paying down their mortgage. However, a few years ago, to focus on the business, they stopped paying off the mortgage and they now run an interest-only mortgage. It's worth 1.3 million and they have just short of £400,000 worth of debt left on it. As explained, they have the beauty business pension, which is very small. They've not been saving into pensions, and construction company pension, also small, because their focus has been applying everything into the business. In terms of the timeline, they've said neither of them will work past 55. This is a hard line for them. We have some other dates here where they may reduce their spending and their slowdowns in terms of holidays, but a relatively simple forecast right now. Now, this is where it gets quite difficult because they have not been saving at all and they have significant future spend needs. If they do cease work, they haven't built up the capital to be able to support their lifestyle. So if we look at this in detail, and this is how we like to show things, where will your earnings, each column is a year in their life, age 37 through to their early 90s, which is where they wanted us to forecast to. And where does this money come from to achieve the spending objective that they've set? Well, until they are 55, the majority of this comes from employment. On top of that employment, we have the rental from the family investment company. We can be really confident about state pensions because we know we're going to hit those. But now we've only got a small amount of savings, investments and pensions that can provide for that. And so there's a shortfall. The other way to show that is if we look at their asset position down here, and this asset position looks really good, but the majority, you almost can't see anything else apart from non-liquid assets. And non-liquid assets are their main residence and their property assets. Take that away. Yes, they build up some pension savings whilst they're working in this blue period, but because of the high spend requirement, this is quickly exhausted as soon as they retire, and they're left with nothing liquid, even though they've got millions of pounds worth of non-liquid assets. And those non-liquid assets are namely their businesses. Now, the discussion here with these clients is the risk that you hold is that these businesses become worthless, cannot sell, don't sell for the amount that you want. And so that is a real consideration for anybody who's looking to sell their business. However, the market is very strong for what they're looking at. And so we initially forecasted a sale where the business was valued on the low end at 20 million. And you can see this because there was a 10 million valuation here for these clients. And there is a sale where you can see this big spike here. Everything else is identical in this plan, but there's now a huge spike where 10 million comes in. There's a big spike the year after where the tax required to pay this comes. And another way of visualizing this is their assets. You know, they have these non-liquid assets, the purple color here, and they convert most of that, the value of the beauty business, to cash here, pay the tax, so it drops down, if you see that, comes in, pay the tax, and then they live off this cash indefinitely up until here. And so if we zoom into this plan, whereas you think, well, everything's got to be rosy if you've sold your business for 10 million, we can see that actually there's still a shortfall in this plan, and it's only when the clients are in their early 70s. And this is because their lifestyle is expensive. And their lifestyle is not just expensive, but they're spending down cash, which isn't growing very quickly. So whilst a 20 million sale of the business is really attractive over here, just doing that alone doesn't work. And so what we've said is, well, would be the amount that is needed to be able to achieve your objectives, and what would the situation look like if you do invest the funds? So here we know that everything is identical apart from the 10 million sale. The clients have now invested these assets rather than leave them in cash. So here, the purple, instead of moving over into the pink savings, moves over into the blue investments. And you can see here how these grow and increase over time, and there is no red in the plan. Ultimately, what this is showing is that the investment growth is enough on the amount that they have sold for and the liquid assets they've got invested to be able to support the lifestyle that they've selected for the rest of their lives over the time period. It's a really good position. What we do like to sometimes show clients in this instance is the question of how wealthy might you feel? And if we add in the legend here and take away your non-liquid assets, and we bring this money back, because this is showing them dying with 30 million, but actually if you bring that money back into today's terms using a real money calculation, these clients always have generally the equivalent of around 8 to 9 million pounds worth of assets, and in liquid assets always around 7 to 6.5 million pounds of liquid assets. This is a really, really comfortable position, because this is how much money it will feel like they will have, because obviously 6 or 7 million pounds today is not 6 or 7 million pounds in 30 years' time. So it's a great way to visualize this. And while all of that is really good, another thing that we know is really important when people go through this period of their lives is feeling really comfortable about what their number is. So here, what we've been able to forecast for them is a business sale required amount. And what this is aiming to achieve the amount that they need. If I show you this on dual charts, the identical life that they've set out, all of the same, all the spending that they're saying is identical the same. But in this scenario down here, if we get rid of their main residence and other non-liquids, we're actually spending down this money over towards retirement, not completely exhausting it, sorry, not retirement, death. Not completely exhausting it, but ultimately spending it down. And why does that happen? Because we've looked at how much they need to sell the business for. So whereas this figure was 10 million previously, which would have been a 20 million pound exit, actually in this scenario, if they sell for 13 million and Mrs. nets 6.5 million, they can still achieve all of the goals that they want to with their life. And that puts her in a really good negotiation period when they go into selling the business, knowing that she doesn't need to sell to the highest bidder. She can ensure that the deal she gets suits her and her family. And therefore 6.5 million net, 6.5 million for her, or a 13 million sale, is probably the absolute minimum that they could sell this business for in a couple of years and achieve the lifestyle that they want. So that gives the bottom line, but what does the top line look like? And again, we can forecast this as well. The valuations and the objective, and her business partner is really quite set on this, is that this business is worth 50 million. They expect to sell to a US buyer. And you can see here that there's a significant increase and spike over there. What does that mean to this plan? Well, the numbers become huge. When you forecast those over time, the growth in these assets means that by the time they're in their 90s, the overall estate value will be 170 million, and even inflation proof back into today's terms, they'd be dying with a 40 million pound estate. Now, those numbers can be hard to comprehend. So what does that mean? Well, it means that if they wanted to maximize their spending, and this is a great way to frame this, if they wanted to die with just their main residence and properties and any illiquid assets, how much could they spend each year, inflation proofed, over their life, and really enjoy their capital? And you can see that compared to the 190,000 that they were saying, they had the ability to spend closer to £500,000 or £600,000 over that time period. And what that can allow for is a lot more spending in the early stage, post-exit, when you can really enjoy yourself and spend some of the capital down, knowing that you've got ample to live off for the rest of your life. Clearly, that's a vast difference in an insight to where they are in the starting position, where ultimately they run out of money over here. That visualization is not great because of these two axes, but their starting position, because they haven't built up the assets, is much lower. So overall, I would just say, with anyone preparing for a business exit, there's lots we can do in the early stage, but understanding what your number is, how much you need, and then working backwards is a great way to be really confident in going through what is a very difficult process. Thank you.